Your retirement account is sitting inside the largest construction boom America has seen in over a century. You did not choose this. The index funds did it for you. Every passive dollar that flows into broad market technology holdings is flowing toward the infrastructure build-out underneath AI, the data centers. The power lines, the cooling systems, the chips. The market has decided this is where the future lives. And the market has been wrong about exactly this kind of story before. America is building at a pace that has not existed since the 1860s and 1870s, when the railroads were being hammered across the continent at a speed that felt, at the time, like proof that the future had already arrived. Billions of dollars of capital were pouring in. Entire industries existed to serve the construction. Banks were extending credit as fast as they could print the paper. And then, in 1873, the whole structure stopped. That is the parallel, not a vague one, a mechanical one. The asset is different, the mechanism is not. The mechanism underneath both booms is the same, and it has a specific name in the history of capital markets. It is called infrastructure overcapacity, the structural condition where the rate of construction permanently outpaces the rate of demand that can absorb it. Think of a river with a single lock. Ships line up for years, so the government funds the construction of a dozen new locks, all built simultaneously, all designed to eliminate the bottleneck. Every lock is justified by the backlog that existed when construction started. None of them account for the fact that the ships are being counted twice, that the demand projections were written by the people selling the locks. The mechanism runs in 3 steps. First, capital floods into an infrastructure sector faster than end-user demand can be verified because demand looks obvious, because the backlog is real, because the early projects genuinely work. Second, every participant assumes that their piece of the build-out is justified by demand, that everyone else will not capture the competitive logic of the boom. Makes rational actors overbuild in aggregate even when each individual decision looks sober in isolation. Third, when the real demand number surfaces, when the utilization data comes in, when the earnings calls stop being able to hide the gap between built capacity and paying customers, the compression of valuations runs at the same speed as the expansion, but in reverse. The businesses survive. The stocks do not. Right now, Microsoft, Amazon, Google, Meta are collectively spending over $300 billion building AI infrastructure in a single fiscal year. That is not a projected number. That is guidance they have already given their own investors. The last time the infrastructure build rate ran this far ahead of verified demand, the lock the market was building was the Transcontinental Railroad. And the year the demand number finally surfaced was 1873. Jay Cooke was not a reckless man. He had financed the Union Army during the Civil War and was considered the most sophisticated banker in the United States. In September of 1873, his firm, Jay Cooke and Company, was the lead underwriter for the Northern Pacific Railroad, a project to extend rail lines across the northern tier of the continent from Lake Superior to Puget Sound. The project made complete sense. The east to west traffic on the existing transcontinental line was real. The demand for more capacity was real. The land grants from the federal government made the financing look safe. Every piece of the investment thesis was defensible. What was underneath it was different. The railroad construction boom of the 1860s and early 1870s had built capacity so far ahead of actual freight and passenger demand that the system as a whole could not generate the revenue the debt assumed. Individual railroads were not just competing for existing traffic, they were competing for traffic that did not yet exist, that was being counted in the projections as if it would materialize on schedule, in the volumes needed, at the prices assumed. The demand was real. The gap between the demand that existed and the capacity that had been financed was the problem. Jay Cooke and Company failed on September 18th, 1873. The New York Stock Exchange closed for 10 days. Banks across the country suspended payments. The railroad construction boom did not slow down in a controlled way. It stopped. Rail workers, steel workers, lumber workers, equipment makers, an entire generation of industrial workers had built their economic lives around a construction cycle that was running on assumptions that the actual demand numbers could not support. The depression that followed lasted 5 years. The Panic of 1873 remains one of the two longest economic contractions in American history. The structure is not identical. The speed of the current build-out is faster. The capital is more concentrated. And the investors exposed to the downside are not the railroad barons, they are the pension funds, the target date retirement accounts, and the index portfolios of people who have never heard of Jay Cook. Nobody warned those workers. The historical record does not promise that AI infrastructure ends the way the railroad boom ended. Patterns can break. The demand for computing capacity may prove large enough to absorb what is being built. That is a real possibility, and the people arguing for it are not wrong to argue it. What the historical record does show is the mechanism, the specific conditions under which infrastructure overcapacity has transferred losses from the people who built the system to the people who held the paper at the moment the break ripped. Demand number came in. The conditions are capital deployment running faster than demand verification, competitive pressure forcing rational actors to overbuild in aggregate, and valuation multiples priced for the demand that was projected rather than the demand that exists. All three conditions are present right now. The data centers are being built. The power contracts are being signed. The earnings calls are still describing a demand environment that justifies the spend. And the passive index funds are buying the equity of the companies doing the building automatically, every paycheck, without a vote from the people whose retirement money it is. $300 billion of infrastructure spending in a single year in a sector where the primary customers are the same companies doing the building. The last time America moved this fast, it took 5 years to understand what had actually been built. And the generation that built it was not the generation that owned the stock. The generation that owned the stock was the one that had been told the demand was there. The question is not whether you have heard of Jay Cook. The question is whether you know what you are holding.